Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NAVITAS Semiconductor CORP quarterly report. NAVITAS Semiconductor Corporation offers a diverse range of power semiconductor solutions to various industries worldwide. Their products include gallium nitride power integrated circuit silicon carbide power devices silicon system, controllers digital isolators for power conversion, and charging. These products cater to numerous applications, such as mobile phones, laptops, consumer electronics, data centers, solar, inverters, electric vehicles. The NAVITAS Semiconductor Corp stock price has skyrocketed in the past year, with increases ranging from 288.85% to 416%. This significant growth can be attributed to several key events and developments. The most impactful was NVIDIA's naming of NAVITAS as a key partner for its Kyber data center infrastructure, which led to a massive rally in May 2025. Additionally, NAVITA's strategic shift towards high-power markets such as AI data centers has been seen as a positive catalyst for future growth. Other contributing factors include the company's partnership with PowerChip Semiconductor Manufacturing Corporation and technological advancements, including over 300 patents related to its GaN fast power. Despite recent financial reports showing a year-over-year revenue decrease, the overall sentiment driven by these developments has fueled the substantial stock price increase. The primary drivers of revenue growth or decline is influenced by a multitude of factors. The most significant contributors to this trend include cost of revenues, net revenues, and product mix and sales volumes. A 52% decrease in cost of revenues for the 3 months ended September 30, 2025, was a notable factor. Additionally, a 41% decline in net revenues from 2024 to 2025 had a substantial impact. Other key drivers include gains/losses in market share and design win traction, pace of technology adoption in end markets, stage of products in their life cycles, competition and competitive pricing strategies, declines in average selling prices due to product advances and market competition, changes in customer and distributor relationships, and shifts in market focus towards emerging technologies such as AI data centers and industrial electrification. Net income and profit margins decline. A shift in company performance. The company's financial performance has taken a downturn, as evident from its net income and profit margins. For the 3 months ended September 30, 2025, the company reported a net loss, marking a significant change from previous periods where net income was not specified. This decline continued for the 9 months ended September 30, 2025, with a net loss of $0.8 million. Profit margins also suffered, as indicated by an effective tax rate of 0.1% and 0.1% for the 3 and 9 months ended September 30, 2025, respectively. This decline in profit margins can be attributed to investment losses and restructuring costs. The company's inability to generate profits and its increasing expenses have led to a decline in its overall financial performance. The company's debt level has seen a significant increase, rising from $41,965 to $59,222. This growth is largely driven by an increase in earnout liability, which has surged from $10,208 to $30,903. However, the interest paid and cash paid for interest have decreased, with interest paid dropping to $0 and cash paid for interest decreasing to $19. Management is optimistic about the company's outlook, citing a focus on high-growth markets such as AI data centers, performance computing, and industrial electrification. To achieve this, the company has implemented cost reduction plans to streamline operations and reduce costs. The transition from mobile devices to these new markets is expected to drive growth, with partnerships with leading manufacturers playing a key role in the go-to-market strategy. Management also highlights its pioneering position in the GaN market, with a proprietary platform shipping in mass production to Tier-1 companies. However, the company acknowledges that this strategic realignment comes with significant operational and market risks. The company has made significant acquisitions to enhance its portfolio. Notably, NAVITAS Semiconductor Limited was acquired on October 19, 2021, and GeneCC Semiconductor Inc. in August 2022. These acquisitions are expected to boost the company's capabilities. On the other hand, the company is shifting its focus away from mobile and consumer products, effectively divesting itself from these markets. This strategic decision aims to realign the company's resources towards more promising areas of growth. Concerns about inventory buildup and supply chain disruption are mounting. The company's finished goods inventory has increased by $688,000 despite a decrease in total inventory value, indicating potential stockpiling issues. Furthermore, an inventory reserve of $3.2 million has been set aside due to soft demand in the China region. Supply chain disruptions also pose significant risks. The loss of a single foundry relationship could have substantial negative effects on the company, while disruption or termination of supply sources or subcontractors could delay shipments and have material adverse consequences. Additionally, the reliance on a sole supplier for GaN wafers may be discontinued, with TSMC announcing its intention to cease production in July 2027. These concerns highlight the need for the company to address these issues before they become major problems. That concludes the financial summary for NAVITAS Semiconductor Corp. Feel free to comment below, and I will be happy to answer them when possible.